So we're talking a lot about personal disability policies and how that impacts the individual. I do want to talk about practice owners because there are, practice owners. You on one hand have a household and a family to protect in these scenarios, but you also have a business, and you have a world of other considerations to think about when it comes to risk and managing risk within the business. So, what are some things that practice owners should be thinking about outside of that individual benefit when it comes to disability?
Yeah, that's actually a great question. Okay, first piece is if there is more than one owner in the business and it is a partnership, do you have a buy-sell agreement that dictates what will happen in the event of a disability? The majority of buy-sell agreements that I have run across do not have that. So if I'm an optometrist and I have a partner who's out, they're out for a prolonged period of time. How long do I want to cover the additional duties that other optometrist is not able to do before I turn and I say, listen, Bob, you aren't going to come back. Let me buy you out of the practice. So there's two keys there. Is there a clause within your buy-sell agreement that stipulates those conditions? Two, has the practice been valued? What is the valuation of the practice? The worst time to figure out what the value of your practice is when you have to buy out one of your partners, okay? I'm going to tie this up with what's called a disability buyout program. Where are the funds going to come to buy out your business partner? Right now, we're in interest rate environments are uncertain at best. Would you want to go out and take out a loan? Do you want to tap into one of your assets? Or would you rather pay pennies on the dollar to have what's called a disability buyout policy, where they have a triggering event with a set dollar amount of money that the partners agree on?
Yeah, that's a great point, and that can be an entire episode conversation on its own in managing the business risks within two co-owners or two partners. If you do have a co-owner in your practice, definitely make sure that you have an appropriate buy-sell agreement, making sure you're working with your financial planner and your attorney to make sure that's written appropriately. And depending on which article or consultant you're working with, there are several Ds. Usually it's several Ds to think about in that scenario. There's death, disagreement, divorce, dissolution, and then one of those Ds, which are very important, is disability. And you want to make sure that even though those scenarios, those triggers are spelled out in that agreement, you know how that's going to be funded, just as David mentioned. And of course, one of the most efficient ways to fund those triggers is going to be insurance. And you need to think about, of course, in death, there's life insurance, but also in disability, there's disability buyout insurance to think about as well. So I appreciate you bringing that up, David. What are some of the other things that owners should be thinking about?
Well, if they have recently purchased their practice, there possibly is going to be a loan or some type of repayment schedule.
Yeah.
Well, if you're not coming in and you're not seeing patients, the money's not going to be coming in like it was. So there's what's called a business loan protection policy, where you can take that out and it covers that loan. So you don't have to worry about defaulting on your loan, losing your practice, losing everything that you put all those years of hard work into. So you have a business loan protection. Another key piece is what's called overhead expense. If you're out for, let's say, 6 months, 9 months, not seeing patients, the money's not coming in, are you going to let your staff members go? What are you going to do about the lease that you have, any equipment you have payments on? I, for one, have been going to my eye doctor for 20 years. How many times, if my eye doctor wasn't there and that office was closed, how many times would I have to go to a different optometrist before that relationship is gone? So I've kind of give you a scenario. Let's say you're an optometrist, you've been established, you're there 10 years, you've got a great practice, you become disabled. The doors have to close. 5 years later, 3 years later, you come back. Where are all your patients? You're starting back at ground zero. So an overhead expense policy is going to pay those fixed expenses. They're going to pay your insurance premium. They're going to pay to keep the lights on. They're going to pay your employees to be around, so that when you get better, you have something to come back to. And if you don't get better, you have something to sell.
Yeah. So I want to ask a few questions on those. On the loan coverage,
Yes,
does that coverage only last as long as the term of that loan? So if it's a 10-year practice loan, someone's either cold starting a practice or buying into a practice. Maybe they've got a 10-year loan. Would it only cover based on that 10 years?
absolutely. Correct.
Okay. And some lenders, for optometrists listening, some lenders will actually require um, that you protect essentially them from you getting into disability while that loan's on your balance sheet. So something to consider there. And in terms of the overhead expense policy, will that allow a practice owner to then replace themselves and go and hire out another optometrist?
Absolutely, and that's really what we see a lot of times is we bring someone in to help out with the practice. Now, it could be someone younger starting out, receiving a salary. There's going to be a lot of different structures, and there will be an offset based on what that person brings in. But once again, how much of a loss do we want to see within this practice? I think we want to keep it as close to whole as possible, so that when you come back to work, you're starting right where you left off.
Yeah, and how long do these policies typically last? How long is the benefit?
Typically, we're going to see a 2-year benefit on the overhead expense, something along those lines. Again, we can tailor it. There's going to be other directions that we can go depending on your situation, but typically that's what we're going to see. And if you've been out 2 years, then things are going to change. But at least it gives you time as well to plan ahead and have a plan, whether it's an exit strategy or how we're going to structure this business.
Interesting. Yeah. And I guess in the short term, if something happens in the short term for practice owners, you definitely want to make sure you have enough liquidity there to cover, at least a month's of your expenses minus your salary as a practitioner. 1 to 2 months there to cover short-term needs, but definitely if you're potentially going to be out, I mean, think about what would happen to your practice if you weren't there. Obviously, as David mentioned, where the patient's going to go, it's very likely the value of your practice is going to drop pretty rapidly if you aren't there to serve patients. So, to protect the value of your practice, this is something to consider. And like you said, after 1 to 2 years, you probably have an idea of whether you're going to be able to come back and whether it makes sense to sell a practice or to just move on. So, thank you for that. That's really great to know.